Welcome back to the program. With the major averages posting modest gains with less than an hour to go in the trading day. A few years ago, Nouriel Roubini was one of the few economists who warned about the devastating impact a bust in the housing market would have on the economy. He was exactly right. Fast forward to today, much of our economic landscape has changed. Roubini, however, is still issuing warnings, pretty dire ones in some cases. A few weeks ago, he posted this on his Twitter account. Third quarter GDP growth is very likely to be below 1% and likely to be closer to zero than a pathetically lousy 1%. So double dip risk is now greater than 40%. But since then, we've seen a pretty good jump in August ISM manufacturing report. Plus, we've got Friday's employment report showing that the private sector added a better than expected 67,000 jobs last month. And of course, today we saw a bigger than expected decline in initial jobless claims. So the question on many investors' minds right now is, are things better than people thought? Here to answer that question is the man himself, Nouriel Roubini, joining the conversation. He's chairman of Roubini Global Economics. Nouriel, great to see you again.
Great seeing you, Maria.
So tell us the status of the economic landscape today. Are things looking any better given what we've seen this week?
No, I would say no. First of all, if you look at the ISM report on manufacturing, the details of it, the inventories versus new orders was terrible. That suggests that actually economic activity is going to slow down manufacturing. The service ISM was actually falling. The numbers on jobs last Friday were good only because the expectations were so low. But, 67,000 jobs is not even enough to stabilize the unemployment rate. We need to create 150,000 jobs every month, in order to make sure that unemployment rate doesn't go higher. We have 17% unemployment, including discouraged workers, partially employed workers. And today's number about initial claims, they were lower, but there were 9 states, including California, who did not report, so I had to estimate them. So I would like to see the final numbers before we see if they've improved or not.
Point. Now, wait a minute. You just said something that's really extraordinary to me. You said we have to create 150,000 jobs every month?
Yes, because the natural increase in the labor force is about 150,000 workers. And by the way, we have lost 8.4 million jobs during the recession, including ours cut is another equivalent to 3 million jobs. We'll have to create 300,000 jobs every month for the next 3 years just to bring back the level of employment to what it was before the recession started. But that's not enough because you're adding another 150,000 people to the labor force every month. So that's another 4.8 million people in the next 3 years. So you have to create 450,000 jobs every month for the next 3 years to bring back the unemployment rate to what was before. There's nobody believes, given these conditions, going to happen anytime soon.
What were you saying, Richard?
The 150,000 jobs is for population growth every month. And we lost 8 million during the recession, but because we didn't get the 150 you're talking about, it's actually an 11 million job hole that we're in. Yeah. So, I agree with you. So what policies... And working Americans are very, very concerned about jobs. Those that have jobs are worried about losing them. Those that don't are trying to find them. So what policies, in your opinion, would be the most effective in creating jobs quickly and cost-effectively at the scale? At the scale we need to get them created.
You're absolutely right. If you don't create jobs, there is no labor income. If there is no labor income, there is not consumption growth, and the risk of a double dip becomes worse. And paradoxically, actually, in the last few quarters, there's been a switch of actually distribution of income from labor to capital and to profits. And these profits are not being reinvested, and firms are not hiring workers. What can we do? It's difficult. We're in a process of deleveraging. It's going to occur for a while, and economic growth is going to be anemic, subpar, below trend for a while. That's what I've been saying for a while. What can we do? I would try to actually subsidize the demand for labor. I think that instead of having an investment tax credit that boosts even more capex spending, this capital intensive, I would do a temporary cut in the payroll tax for 2 years, financed by these increasing taxes for the rich. If you want to increase demand for labor rather than demand for capital, I would do a payroll tax rather than investment tax credit like Obama suggested. So that will be something that actually reduces the labor cost for the producers, reduces actually also the burden of the payroll tax.
Would the unions go for that?
Yeah, we're looking at a number of things along those lines to help out with it. But what about infrastructure? The president's proposed a long-term infrastructure, which was the mistake we made in the stimulus package. In the stimulus package, we could only invest in projects that were going to be completed in 18 months. So the big job creators were excluded from the stimulus package.
That's crazy. Why would we only invest in things that could be completed? And by the way, what infrastructure project is done in 18 months. You go to the highways near my house, it takes 10 years just to get the road paved. I'm sorry, but I mean, these are long-term projects.
But what he's proposing now, the $50 billion, really is good. 150,000 miles in roads, 4,000 miles in railroads, 150 miles of airport runway. All of those things are necessary because we have a $2.2 trillion infrastructure deficit in this country that makes us less efficient and less competitive as a nation. This helps with both of them.
Which brings me to the next question, how are we going to pay for this? But before that, Nouriel, you have this prediction, basically, that things are going to get worse before they get better. Is that a fair statement?
Yes, you know, if you consider what happened, growth in the second quarter was estimated originally 2.4, then 1.6. Given new housing numbers going to be revised to 1.2, that's already a growth recession. And we know the second half of the year is going to be worse than the first half because all the tailwinds to growth become headwinds, right?
What, like
the fiscal
cash for clunkers?
Cash for clunkers. We have had the fiscal stimulus becomes a drag on economic growth. The base effects are gone. The census effect is gone. The inventory adjustment is gone. And we had a whole bunch of tax policy that stole demand from the future. Cash for clunker, investment tax credit, the kind of home buyer first-time tax credit. As soon as expired, demand for homes has fallen. So we know the second half is going to be worse than the first half. You look at the data for July and August, they all suggest a slowdown. And if we start from 1.2 in the second quarter, the third quarter already looks tracking less than 1%. And 1% may be not technically a double-dip recession, but it's going to feel like a recession because there's not going to be job creation.
Which is what we've spoken about before. Who cares what you label it?
Yeah.
It's how it feels, right? So how much of this is priced into the market in your view, Nouriel? I mean, do you think that the market is expecting this kind of situation where things are going to get worse, or do you think this, because then there's like a vicious circle, isn't there? If it's not priced into the market sells off, it makes it even worse. So
Absolutely.
How much of that? Talk about that.
Well, it's not priced in the market because consensus forecast for the second half of the year is right now 2.5% growth, while my prediction is going to be below 1%. So conditional on being right, you're absolutely right. There'll be a vicious circle because the economy is going to surprise on the downside, the stock market is going to correct, credit spreads are going to widen, there'll be a negative wealth effect on consumption investment, the cost of capital is going to rise, and then you have another shock to the real economy, and you enter in a vicious circle in which you can go off the cliff. That's the risk we're facing right now.
Oh, God.
I'm concerned that the big banks aren't lending to the small and mid-sized businesses. Do you have the same concern? And if you do, what can we do about it to change that and get that lending going so that we can get job creation started there?
You're absolutely right. You know, the banks are sitting on $1 trillion of excess reserves. They're not lending it, whether it's a credit supply or demand effect.
They're afraid of FINREG.
Huh?
Aren't they afraid of FINREG? They don't know what their businesses are going to look like in 2011?
That might be part of the reason, but I think that actually more QE is not going to make a difference because if you're going to give them another $1 trillion excess reserves, if you're not lending the first trillion, why would they lend the second trillion? We have to do something on credit creation. And by the way, the markets are divided. High-grade corporates have access to both capital markets and bank lending. It's the small and medium enterprises that are squeezed. What can we do? There have been proposals by the administration to provide incentive to smaller banks to provide more credit to small and medium enterprises. We have to do something with the credit intermediation mechanism. It's blocked, and monetary policy is not resolved because the problem of the financial system are not problem of liquidity. There's plenty of liquidity, but of a blocked credit system, both in terms of the supply of credit and the demand for credit. So we have to act on that channel.
Real quick on the emerging markets, isn't that one part of a good part of the story? And I know we don't want jobs to go outside of the United States per se, but the emerging markets are growing. Is there a way that American companies can benefit from that?
Well, emerging markets are growing, but in the rest of the world, half of the Eurozone is not growing, is contracted, the periphery. Japan is on the verge of the double dip. The emerging markets are doing well, but many of them, like China, depend on economic growth in US, Europe, and Japan, because an export-led growth industrialization model of growth. Therefore, the slowdown of US, Europe, and Japan is already leading to an economic slowdown in China, in India, and even in Brazil. And therefore, they cannot be the main locomotives of global growth. China is not large enough to be the only engine of global growth. We need growth in the United States, in Europe, and Japan. That's not occurring.
Let me come back to small business for a second, because we know that they're their engine, and most of the time with a lot of job growth. The AFL-CIO has proposed taking the leftover TARP money and the TARP money that's been paid back and forcing it through regional banks to get lending started to small and mid-sized manufacturers and companies. What do you think of that idea?
I think that anything we can do, whether it's using the TARP money or other initiatives to induce banks, especially smaller banks, to lend money to small and medium enterprises, is going to be positive. As you point out, 2/3 of job creation occurs at that level, and they're not creating many jobs.
As an investor, I want to raise cash right here, right? As an investor, should I be raising cash?
Well, you know, given the outlook, I think there are more downside risks to stock prices than upside risk, and therefore, yes, I would say better safe than sorry.
Nouriel, good to have you on the program.
Great being with you.
We so appreciate your insights, as always. We've got 30 minutes before the closing bell sounds on Wall Street, a market that is fractionally better on